Welcome, everyone. So glad you could join me this Thursday along with Leah Slaughter. Welcome, Leah.
Thank you.
I'll just wait a couple minutes while people come online. Very happy to be presenting to you Real Income Properties Texas 1 LLC. This is our North Texas fund. We've had many people ask if we were doing a fund, and the answer is yes. And this is really for people who just kind of would like to be more diversified and be more passive. But Leah will also help you if you want to be more active and want to build your own portfolio. For those of you who have listened to any of our recent webinars, Leah has been giving lots of great advice and information. She's been working with our clients at Real Wealth for a long time, probably, what, 12 years now, I think?
Yeah, I think 11 or 12 years.
Yeah, so a lot of you already know Leah. And this was probably in May that we had our event in May in Florida. And we were like, you know what, there's going to be so many good deals. We need to be ready with lots of cash. And thus the fund was born. So welcome. We'll go ahead and get started. So I am Kathy Fettke, co-manager of the fund. And I just want to give this quick disclaimer that this presentation is not a solicitation of an offer to purchase securities. The offer is only made through the Private Placement Memorandum, the PPM, and you download that PPM from the growdevelopments.com website, growdevelopments.com website. And the PPM is the legal documents that explain what we're doing here. So just want to make sure this is a marketing presentation, but the actual offer is from that PPM. It is definitely something that will put you to sleep if you read it before bed, because it covers everything, and that along with the operating agreement. So in any kind of fund situation, you really want to understand the waterfall, which means how the money flows, who gets it and when, and who's managing it, and what kind of voting rights you have. All of that is in the LLC agreement and in the operating agreement. So again, you can get all that at growdevelopments.com. And I always really recommend that in something like this, you check with your CPA to see how it fits with your particular situation and what those tax consequences will be for you. So definitely bring those documents. Your CPA should be familiar. If they're not familiar with PPM or a operating agreement, then you might need a new CPA. Past performance is no guarantee of future results. So bottom line, you know, there's real estate is probably one of the best investments today. I'm super glad I was not into crypto and didn't understand it. I like hard assets, as does Leah. That's why she's laughing. But even with real estate, there's risk, not as much as somebody taking your money and spending it on political campaigns. But anyway, but with that, you know, every investment has risk. Okay, so today's agenda, we're going to meet the team, talk about the market dynamics, which are incredible. It's always fun to talk about. Fund details and how to subscribe. And before we get into this, because this will be a long presentation, this particular fund is for accredited investors only. And that means, that's defined by the SEC, is that you have either, any one of these, you either have a net worth over 1 million, excluding your primary residence, so the equity in your primary doesn't count, unless you do like a equity line and put that money and season it for a few months, then that counts. But as long as it's in the equity in your house, you can't count it. So you need a net worth over $1 million, individually or with a spouse. If you can prove that, you're good. Or you have an income over $200,000 individually or $300,000 as a couple. That's the easiest one to prove. You just show your tax returns or your, your pay stubs, and that would be in each of the prior 2 years. Or investment professionals in good standing, holding the general securities representative license of Series 7, or investment advisor license of Series 65, or the private securities offerings representative license Series 82. That's new. That's a new accredited investor definition. So about Leah, besides this adorable photo, which I love so much, and her husband, who Michael just got licensed in Oklahoma. So now you'll be representing some properties in Oklahoma. That's amazing, and we're so happy to hear that. Yes, and he was like mayor of your town, right, for a while or something.
He's mayor pro tem and on council, yeah.
Yep. So these are busy people. Born and raised in DFW, in real estate since 2006. They own together approximately $39 million in real estate. So don't let their youthful appearance fool you. They are very, very, very experienced. They own multiple companies, including OmniKey Realty, and Leah is a national real estate speaker, commentator, and educator. And of course, like I said, many of you know her because she's been working with real wealth clients for years. So now I'll hand it over to you and Leah's favorite topic of why would anyone invest in DFW?
It really is my favorite topic though, because I'm so passionate about it. And you know, it's so funny. Anyone who's seen me speak before, you know, I love North Texas, and I'm biased because I'm from here. I've lived here my whole life, but it's also because of the opportunity that Texas has provided us, and specifically North Texas. I think that everyone kind of knows Texas is doing well. Texas did well through COVID. Texas has done well since. And with what's happening right now in our economy and in our world, it's even more important that we look at these local market dynamics when we're trying to figure out where we want to invest. And so I think at the end of the day, everything that's happening in North Texas, the growth, the income, all of these things that are creating this fantastic investing environment are because of our growth, and that growth specifically as it pertains to people coming here. And so, you know, at the end of the day, our entire country is in a housing shortage, and I'm going to talk a little bit about that in a moment. But we have to be able to sustain a number of homes to hold the number of people who live in an area. And anytime you see massive influx or growth, it creates a supply and demand issue. Right now, we're in a unique situation because we already have a supply and demand issue. So if you look at what's happening right now, we just hit 8 million people. For those of you that have been investing with me for years, you know, previously I was talking, we were at 7 million people. The growth is astronomical. So the forecast right now through 2045 is that we're going to add another 3.5 million people. So we are currently the 4th largest market in the United States, and we are going to be the 3rd largest sometime in the next 10 or so years. We'll overtake Chicago. Approximately 1.5 million new households, and we're going to need 184,000 acres, almost 300 square miles of housing. And that's just obviously not sustainable. One of the things that has artificially kept Dallas's and DFW's prices kind of low is this wide land mass availability. Unfortunately, we're starting to get to a point where a lot of these cities are getting landlocked. And so we've seen the movement where lots are smaller because prices have gone up and land is getting scarcer. We're going further and further out. And that allows a great opportunity for us as investors right now because we do have a city layout that allows us to invest in the suburbs. And I'm going to talk a little bit about that too.
Okay.
So if you look by numeric population growth, you will see that Dallas-Fort Worth has led the charge, and we had almost 100,000 people come in a 1-year period, and our numbers are staying pretty consistent. 4 of the top 10 fastest growing metros are all in Texas. So Texas and Florida right now are leading the pack. And we saw the largest growth, of course, through Texas. But what's interesting is what's happening with our baby boom. And I'm going to talk about why that's important from a housing shortage perspective. Our population exceeded 8 million during the pandemic. We were already having massive relocation here. And what happened during COVID just put this to a new level. More and more people were able to work remote. More companies came here, and so relocations took what was already a large number and just went up astronomically. Of course, during COVID, a lot of people also wound up having children, and so that increased our population dramatically as well. So again, by the 2030s, we're expected to replace Chicago in the 3rd position. So if you look at the population change from 2010 to 2020, the reason I want to show you this is I think it's important that you understand this is not something new. I think a lot of people misunderstand that Texas is just now starting to grow and Texas is just now starting to boom, and that's not the case. This population trend of growth has actually been happening for over a decade. Texas has been just experiencing a massive amount of influx here from people moving from all over the country and all over the globe. And so if you look at the other top markets, so again, our comparison of the markets we're up against here are Chicago, LA, and New York. We're number 4. So these are what we consider our competitors. There are similar market dynamics, similar income ranges. What's not similar, of course, is the cost of living and the cost of of real estate. So you can see here that Texas has been growing for over 12 years now at a very, very fast pace. But when you look at us compared to all the other top markets, we had 20% growth. Chicago had 1.7. LA had 2.9, and New York, Newark, Jersey City had 6.6. And so when I talk about how unique we are as a large market, not only from our pricing perspective, it's also the market dynamics that offers that unique diversity and stability that North Texas offers. And a lot of that comes from that we're still acting like a small city or a small metro, and yet we're performing like a large one. So again, 20% growth compared with the next closest to 6.6. That's pretty incredible. And that's New York, which is artificially a little higher because of how many people just go to New York and how many people go there for a lot of other things, not just business. It's really quite incredible what's happening here right now.
Yeah, this is very important to notice, because often people like to compare today with 2008 or 2007, or, you know, and it's like you can't. It's a different city. There's no comparing Dallas today with 12 years ago.
Yeah, and I mean, I'm fielding this all the time, right? Well, but the market's crashing, the market's crashing. This is not a market crash. This is a halt. This is a stall because interest rates are high. On the back side of this, what we're expecting to happen is, if you knew what was happening in North Texas 6 months ago, the crazy offers over asking, we still, by the way, are having a vast majority of our properties having multiple people interested in it, and that's just supply shortage. This is only interest rate driven. You can't have a supply shortage and expect that prices are going to drop. It just doesn't work. But people are on the sidelines until rates ease, and we already got good news today that rates have come down significantly. And so it's just a matter of time, in my opinion. I don't have a crystal ball, of course, but for me, I think what's going to happen on the backside of this with our market dynamics is a crazy market like we've never seen before. You know, I wish I could sit here and tell you that we're going to grow and not turn into LA or New York or one of these larger cities, but just the truth is that we are these larger cities. We're just still underpriced. And when you look at the new jobs coming here and what people are being paid in those jobs, and just the extreme shortage that we have in the relocation, it's just kind of common sense of what's coming. So right now is that unique opportunity we keep talking about, the calm before the storm. And I'll talk a little bit more about those items as we get there. So this is really interesting. And the reason I put this is I want you to understand how many households are going to be coming from those under 18 in our state relative to other states as well. So this is looking at Texas. You look at where we were in 2020 and where we think we're going to be in 2050. The percent of growth under 18 population is over 43% almost. And so when you think about how large our population already is and how many people under 18, that means are going to be aging into the age to go rent a home, rent an apartment, buy a home. It's unbelievable. In and of itself, the supply demand that's going to create is off the charts. But if you look at the rest of the country and what they're seeing, I want you to see the percent growth of the under 18 population on the US basis. It's only 5.8%. So does this mean Texans are having more babies? Does it mean more younger people are moving here who are still in baby rearing age? That's a conversation for another day. But the bottom line is that our supply and demand issue is only going to compound. It compounds for a lot of reasons. A, we didn't build enough homes the last 20 years, and we'll talk about that. But also the number of people that are going to be becoming homeowners or renters or that are going to need homes when we're already dealing with a shortage of new construction of almost 200,000 homes. So it's a severe crisis, and I do use that word because it truly is. And I don't think that we're seeing the effects of how bad that crisis is going to be yet. I think that if you follow city of Dallas and a lot of these inner cities, there's a lot of talk about unaffordable housing and how the lower income classes are just not able to get property and rents are skyrocketing, and all of that is happening. From an investor standpoint, that's what we want to happen. We want to see those values go up. We want to see rents go up because, of course, that's where we make our income. But this is just going to compound that problem. So DFW metro areas, we saw last year almost 30% price gains. We led the nation in price gains. But the thing I really want to focus on is even in what's happening right now, the short little pause, we're still up over 11% from last year, October to October. Now you tell me that's not incredible. I don't think there's many markets that can say that right now. And that is just about the resiliency and the strength of the North Texas market. So all of these things that we're talking about, these are hyper-local numbers, hyper-local situations. It's important that when we as investors are scoping a market, that we look at what's happening regional and local, not at what the news is telling us for the nationwide market, because as I say a lot, there is no nationwide market. There are local markets, and that is what we are researching. That is what we're investing. New home prices are up 34% to 375,000 since 2020. So that's the type of gain that we're talking about in this area. And that's, for those of you who bought 2 years ago, bought a year ago, you've made a killing. You've made a killing. And obviously that is the trend that we want to see continue. So let's talk about the inventory shortage, because one of the kind of things that people are talking about right now is, well, inventory is way up. It's way up. But what they don't tell you is, yeah, it's way up, but it's still way down. So as of the numbers that just came out from our association, we have 2.4 months of inventory across North Texas. And that's as of October 2022. So these are the most up-to-date numbers. That's less than half of what a balanced market actually is. And if we compare the number of listings on the market today to the same time in 2019, we are still a third down, or 7,500 homes down. And I already showed you how many new people have moved here, meaning how much more inventory we should have on a percentage basis. So even in the pause that's happening right now, we still are far down in inventory. And that's one of the reasons why our market is so resilient. Again, supply and demand is what drives consumer prices, and that's playing a big role right now. It's also one of the reasons why they struggled so much to control inflation, right? Because there's still this goods shortage. And so it's very complex. But at the end of the day, what you need to know is these market dynamics benefit us as investors, and it benefits us as homeowners here. We have the second most severe housing shortage in the nation. So that's important to note. New construction shortfall just through 2020 going into COVID was 167,000 homes. That's massive. That's how many homes they should have built that they didn't. So this kind of shows you our housing inventory, and this is a recent chart. And so you'll see here where we were in 2017, and you'll see where we are now, just highlighting how far below normal market trends prior to all of this growth the last 5 years we truly are. And again, this is right now in the pause. Imagine what happens when the market restarts.
Exactly. When you see the chart, you know, the news media is going to say, inventory's doubled. And when you see the rise there in this year, it can be a scary headline. But then when you pull back and look at the big picture, like, it's still so low. And if you go back to 2017, as inventory was starting to rise, that's when they started raising rates and then lowered them. Look what happened when they lowered them. So, yeah.
Well, and you see these dips every year. This is nothing similar from what typically happens. But what did happen is that COVID kind of threw off the timing. And so everything is still kind of resetting. You know, when we went through COVID, our prime season was delayed 2 or 3 months. It was actually quite interesting because we had tenants moving out after summer instead of during summer, and a lot of market changes. And, you know, the world is still kind of reeling from that. The markets are still reeling from that and trying to figure out, well, what is the new normal going to be? Is it going to stick where people only move in summer, or are what we're seeing right now where people are kind of moving all throughout the year, is that going to stay the trend? And so it'll be interesting to see where that levels out to.
Yeah.
So this is integral to what's happening here. And I think it's important that we talk about, again, 4th largest market in the United States, but what are people actually earning here as prices are going up? So you'll notice this article here on the left that the Dallas Business Journal did. It's specifically talking about, well, yes, we've had these massive rent increases, but the people moving here can afford it. And that's what's so unique about our market relative to the other 3 we talked about, Chicago, LA, New York, where unaffordability has reached crisis levels. Well, why is that? So almost half of the new jobs coming here are making more than $150,000 a year. And in a market like Texas and North Texas specifically, that's a very high income. Less than 17% are earning less than $75,000 a year. So these jobs coming here are high paying jobs. And one of the reasons why that is they're coming from states where the cost of living is so much higher, but it's also because we have a massive worker shortage. My favorite restaurant is having to close early because they don't have people to come wait staff. Everything has changed in this post-COVID world, and especially in your lower income ranges where you've got, you know, service industry and those types of jobs where people are not wanting to go back to that. And so you've got so many jobs coming here, so much growth happening here. It's just very, very hard to get people to fill those jobs. And so we have more jobs than we have people to work them. And so employers are having to pay more. And that resonates not only into these jobs that are coming here already at high pays, but also what the new jobs here or replacement jobs here that have been here are now paying. I can tell you, just as a business owner myself, we've raised starting salaries about 30%. So it's across the board. Quote, household income in the region has recovered more strongly than the national average with the fallout from COVID. We were the first to hit recovery numbers. We went above and beyond recovery numbers while other states were still far below what they went into COVID with. So again, it just speaks to North Texas's resiliency, and the resiliency comes from all of these things that we're talking about. The rent to income ratio in Dallas after these increases, 22.5%. Fort Worth side was 18.9%. So when we look at like a debt to income ratio, when we see someone only spending a quarter of their income on housing, that's a fantastic statistic. And if you come visit here, that's why you see so many shops and outdoor malls and venues and stuff outside. It's everywhere. And that's because people here do tend to have more expendable income than you see in other areas because of the affordability. To find a pairing of affordability and a large metro like we are in the top 5 is pretty much unheard of. Now, this is, at the end of the day, what I want you to take away from this is everything I've told you tells you why I don't believe we're in 2008, and I know we're not in 2008. But if you're going to take away one thing from today, this is what I want you to take away. Only 1.21% of our mortgages are currently underwater. It's historical lows, 1.21%. The average homeowner gained in equity just last year, $72,000. Now, I could tell you nationwide statistics that people owe the least on their houses that have happened since they started tracking mortgage loans. The average homeowner has over $300,000 equity in their home. So statistically, this is a market resiliency nationwide. Specifically, though, North Texas and the strength that it has, we have one of the lowest percentages of underwater mortgages, meaning that they owe more than the home is worth. And that's even after all of the crazy purchases that happened. And why is that? People have cash, they put a lot of money down. The crazy financing terms of cash out refinances you can't do here in Texas. You can only go to 80%. And on investment property, you're going to 75%. So people aren't going to walk away, but also these homes are holding their value and rising. Again, we're still up 11% year over year as of right now. So these are, again, just all of the things that tell us how strong our market is and what we should be expecting on the backside of rates coming back down.
Yeah, but, yeah, people don't understand that with the bidding wars and people making offers over listing price, that the appraisals didn't necessarily come in. So people had to come in with cash to make the difference. So you know, you don't have to worry about those people just walking away. Like they wanted that house bad enough that they were going to pay over appraisal, you know, and it could, because appraisals require several comps. You can't just because one house maybe next door sold, you need to show a lot of them. So anyway, you don't have to worry about the people who overpaid because they had to pay in cash.
Well, and the value kept up with it, right? I mean, they were overpaying, but by the time they moved in and got settled and all of that, the values had gone up 30%. And yeah, again, we're up 11% this year. So we're talking 40% in 2 years approximate, or, you know, even 38%. That's a massive, massive increase. It's the single largest investment most people are ever going to make. And we made a lot of people a lot of money just in those market values. But it just goes to show you the difference, because in 08, anyone who could breathe could get a mortgage. And I even was putting investors in properties with no money down. We were doing purchase plus loans and all these things where people had no stake. They had no reason not to walk away. It's a completely different world. It's a completely different world. I don't really know that there's a way that it could even happen again with today's laws and rules and dynamics here. But the end of the day is, this is not 2008. This is not a crash. This is a pause only because rates are high. This supply shortage, although I love talking about what's going on in North Texas because it's extreme here, this is a nationwide issue. It's a nationwide issue, and the minute that rates ease, we are right back in the same boat, except now people are not going to sit on the sidelines because they're scared to death they're going to get priced out. And so I think what's going to come on the backside nationwide is going to pale anything we've seen before. So rents are keeping up with this. Between August 2021 and 2022, they're up almost 15%. Just between May and August, we're up almost 12%. And why is this? People have to have a place to go, and there's just physically not enough property. And so our summer was crazy with rent increases. I had 2-bedroom units that I had the previous year at $1,025 that I'm renting now at $1,250. So these increases were significant. And I think as we continue to go out of this pause and back into rates dropping and a lot more people come to buy and all these people moving here have no inventory, this is going to continue to compound. What we're seeing right now going into COVID on the Dallas side, about 50% of people were renters. Historical across North Texas were between 40 and 50%. When rates went up and the housing shortage got so bad, we took 40 to 50% renters and we made that a more difficult situation for them to navigate to purchase. And so more people became renters. And then when you look at how many institutional buyers and investors bought our real estate in the last 12 months on the Tarrant County, the Fort Worth side, it was the majority of homes went to investors. And so we've really priced out your traditional home buyer. So right now is the time, if you were a regular home buyer looking for a place, this is when you should be buying, because this might be your last chance, because there's a reason all of these hedge funds and everyone are watching North Texas and buying up everything they can get their hands on, people like me. And that's because we understand market dynamics and we understand what's coming. And rents are gonna, in my opinion, continue to rise because there's just not gonna be inventory when we get back into prime season. So just some charts for you to take a look at and see. So this is employment growth on the left, and this will show you, of course, how quickly we regained back to COVID levels and how far above that we are right now. Our employment rose about 8.5% in July, even faster than June, which was 3.1. It's just incredible growth here right now. And the more that the news talks ill of what the market's doing, the more people are coming here, the more businesses are coming here. I mean, heck, Elon's talking about bringing Twitter here. So it's just a little bit of everything. And again, this is not going away. The more that these other markets struggle, you know, you look at our market dynamics right now compared to Chicago, LA, and New York, who else is up 11% right now? Who else is in the situation we are with affordability? And so it makes employers want to come here. It's cheaper for them to operate here, no state income tax. Single largest deal in economic development history on our enterprise fund was just nailed in Sherman. I'm going to show you that in a little bit. There's so much development and business relocation coming here that this trend is just going to continue.
Yeah.
And again, looking at our unemployment rate and how quickly that rebounded, we're sitting in the low 3s, which is basically considered no unemployment because you're always going to have those people sitting. And so it's really quite incredible. It's really quite incredible. So this is just a snippet of some of the companies that have relocated here this year and last year, just to kind of give you an idea, not only of what's come in from large corporations, but also where they're coming from. And of course, you're going to see a pretty consistent list there from California, a lot coming from the Northeast, even some coming from Florida. It's, again, it's a little bit of everywhere. We've got companies coming from overseas. You had a company came from Israel last year. It's, again, trying to get to what North Texas offers. It's also easy for them to come here when other companies they work with have come here. For those of you that heard me speak years ago, I talked about Sherman and how Texas Instruments came and how I said other tech and chip manufacturers are going to start coming here because it's easier for them to liaison and coordinate and ship and all of those things. And sure as heck, what's happening? All of those companies are coming here. And so it just makes sense, right, logistically and also from an operational cost standpoint. If you haven't looked up the North Texas and the Texas Overall Enterprise Fund and what Texas is doing with incentivizing businesses to come, make sure you look that up.
Yeah, they're the best at it. So we can just kind of fly through these, but these are just some of the headlines that we grabbed of companies moving. Got this one, Stadium Food Delivery. North Texas lands another California company headquarters. This one is liquid manufacturing.
Yeah, we're getting we're getting manufacturing, we're getting tech, we're getting healthcare, we're getting all sorts of stuff.
Pharma, Caterpillar. I mean, it's like, it's not any one industry. They're just all moving. And then of course, this was the big news. We've showed this before, but we know that a bill was passed with $35 billion in investments going to bring semiconductors back, and that's a lot of that.
It's going to be Sherman, and the reason being, you've got Texas Instruments, you've got Finisar. You know, we were doing Apple Face ID technology up here when that came out. It's, again, these companies are here. They realize that they can move one county north of the inner city and operate way cheaper. Their people don't mind a 30-minute drive because our highway systems are so expanded and easy to operate and drive. It's just a very different geographical layout than these other top markets. These companies aren't coming into the cities, they're coming into the suburbs, and that's because we can offer in a suburb what small towns can offer. And it's unheard of for a large market.
Yep.
So this is one of the things that happened in Sherman in the last few months. So this is Globotech, 1,500 new jobs, $5 billion investment. It's the first manufacturing plant of its kind in the last 20 years. Essentially, these companies looked at overseas and looked at a couple states, and they decided to come here to manufacture here. So it's American jobs, it's income for American citizens, and it's bringing all of these things that we ran out of during COVID back to America. And so this is huge because, you know, it's kind of like a domino effect. Once one starts, the next comes, the next comes. And that's exactly what we're seeing. And it's not even taking a lot of time. We had 2 announced back to back. I think if you go to the next, I believe I put the next one on there as well. Yeah, here you go. So here's TI that is doing a $30 billion investment in Sherman. I mean, guys, these are small little areas. Funny enough, one of the top 10 fastest growing MSAs in the country is the Sherman-Denison MSA. A huge chunk of my portfolio is in this area, and a huge chunk of what's going to come into the fund is going to be in this area as well, because this is just one of our favorite areas. And the reason that we opened in Oklahoma is because it's all drivable to this. It's only 5 minutes north. And so, you know, you've got Sherman and Denison together, and then the Oklahoma border. So right here and right here are where you want to sell to get into the employers. And so it was very important that we secured Southern Oklahoma so that we can make sure that we continue to add to that inventory. This area is booming. This area has high-tech paying jobs in an area that's never seen anything like that before. And I think probably the biggest piece of what's happening is the incredible city leadership that's happening in Sherman and especially Denison. Very, very close with those people there, and they're brilliant. How they run their city, the way they give back to their community, they invest in their economy, they invest in their community. It is unlike anything we see in other cities out here, and it really is just quite incredible. So here's that $5 billion silicon wafer plant we were just talking about. So that's going to be a $5 billion investment. Production will be up and running by 2025. They're moving quick. And this literally came only 2 or 3 weeks from the TI announcement. So then that leads to the question, well, what else is in the works right now? So you remember that I said this will not be the last. So these are our target markets. I kind of look at it like a dartboard, and it really, our green area is a little bit wider than this, but we avoid the inner cities. That's the important thing to keep in mind. We only want to go in the suburbs. We only want to go where we see the market dynamics of the high growth, where there's their own jobs in these areas, but it's also drivable into the main metro. We want to be out of the inner cities. We want to be out of the inner counties. The politics of how business operates is completely different in the inner cities and in the outer areas that we're talking about here. In reality, the further out we go, often the better the returns and the better the growth. We want to stick to affordable entry-level housing. We'll talk a little bit about that. Of course, areas that are experiencing heightened growth, not just from appreciation, but also natural increase of the area expanding and growing, becoming more desirable, becoming a larger metro. And then, of course, drivable into any employment center in the area. You can look at our highway system here and just see how incredible it is. And, you know, while everyone else in the last crash was reeling and trying to figure out what to do, we built our airports, we built our roads, we did toll roads, we did all of these things, and we stay ahead of the curve of growth because Texas is brilliant. They knew what was coming. And so we just don't have those traffic patterns that you see in the other top metros. And because we're so interconnected, you can live 50 miles from where you work and still get there in less time than to commute in LA. And that really is what has kept our prices down because there's so much land mass available.
And this gray line is Oklahoma, so you can see how close it is, right? Yeah. And yeah. This green really should be going up here, right?
Yeah, I think when it translated into this, it just shrunk it down a little bit. But yeah, so really in reality, up where you see Durant, that's kind of right at your border. Denison goes up a little bit. You can't really see where that dotted line is, but we stop at the northern end of Denison for this fund, and we'll go all the way through where the rest of this green is. So that fourplex that I just mentioned that I bought in Oklahoma is right there in Thackerville. So if you look at the top, where Gainesville is and right north there to Thackerville, that is that kind of southern corridor of Oklahoma that we're talking about that is going to be the next area to piggyback. And so I'm sure we'll be talking about Oklahoma sometime in the future.
Yeah. Okay. So with the fund, knowing all this, and you know, I know some people maybe are not accredited and won't qualify for this fund. Unfortunately, it's an SEC rule. I hate it. I wish everybody could invest. It's just that if we want to talk about it publicly, then you have to be accredited. It's the law. So this is the plan. Again, in May, we sat down at that live event. If you were there in Florida, then this is where we really solidified the idea that we knew with the rising rates that there was going to be more opportunity, because up until now, it's been so hard to get anything. I mean, Leah always finds a way, but it's been a lot harder to find inventory. And we knew it was coming, and that there would be, you had to have cash. So it's like, oh, we got to have a fund that's ready with cash to buy. And so the business plan is to acquire 1 to 4 unit properties, renovate them with high-end finishes to attract those high-paid, high-salary employees, and again, lease to the high-paid professionals in the rapidly growing markets throughout North Texas. So very simple business plan. I have done some complicated business plans in the past that were complicated and difficult. So it's like, boil it down, dumb it down. This is it. That's all it is. Nothing more. That's it. Target return 8%, time frame 3 years to 7-year hold. And I know one of the questions we had got is, what does your pro forma say when we were doing the numbers? Is it higher? And the fact of the matter is, we're not going to gamble. This is what Leah is absolutely certain can happen, unless some tragedy happens to America or to Texas. That this is a return she's very comfortable with. Could it do better? Of course it could. And you can decide those numbers. We're not going to state it, because who knows what the future holds. There could be much higher appreciation, but we're not going to put that in here. This is the target return. This is conservative. This is what Leah truly believes can be done. Now, with the time frame being 3 to 7 years, it just takes off and the numbers are ridiculous. Maybe we exit it at 3 years, right? If the cash flow is incredible and the rents keep going up, maybe we want to hold it, but we're kind of keeping that open. Leah, I talked to somebody yesterday, a big investor, who said, I want you to hold it forever. So anyway, maybe that's the next fund. But would you want to explain why the 3 to 7 year hold?
Yeah, so for those of you that haven't heard me speak before, we preach a 2 to 6 year hold. And the reason that we do that is because every year you own an asset that's going up in value, the value doesn't go up at the same rate as rents do. So like last year, for example, values went up 30%, rents went up somewhere between 14 and 20. So you're essentially losing value every year in your return. And so it makes way more sense to sell and 1031 exchange and reinvest and continue to double the portfolio to have more properties cash flow and more properties for tax deductions and cost segregation and all of these things. So that's not to say anything we sell before year 3, if we were to do that, it would reinvest back into the fund. But this fund, the goal is it's twofold, right? It's cash flow, but it's also capitalizing on right now equity capture properties that we buy with massive amounts of equity that then turn around and appreciate and cash flow until we exit. And so there's lots of different investing models. What I'm giving you access to with this fund is how I've amassed my fortune. And that is through this exact model. It's not something that I can go offer to our 1,500 investors, because I can't oversee 1,500 clients worth of investment refinances and renovations and all of that. And so really the options are that you do this model and follow where I've made my money and I've made my portfolio and get access into that, or you do traditional investing. And you know, it's very difficult in a market like what we're in to find properties with equity. But we've been doing this a really long time, and because of our buy volume and our just relationships and really what I've spent my last 17 years building, that we get incredible deals. And so I'm going to show you some examples of what I bought this month. The most up-to-date numbers are the type of numbers that we're seeing, so that you can see why we're saying this is so conservative. A lot of these properties right now have 20% equity day one. And so, you know, when we're projecting not much more than that over the whole term, it's real easy to see what we're looking at. And so, you know, again, we want to be conservative because we are in a time where rates may take 6 months to come down. I think personally they're going to be down by summer, but what if they stay up? This is run based on cash numbers, and our hope is that rates are going to come down a little bit. I've got great access to financing options, and that we can go refinance it on the back end to go buy a bunch more, and then the return goes up and up and up. And so, you know, I'm very transparent. I want to be conservative. Kathy does too. That's how we operate. And so our hope is we're going to do way better than that. But I want to give you something realistic for expectations, worst case.
So the plan, again, forced appreciation. We didn't do this with our last single family fund. We just kind of bought at retail prices. This one, we're getting to invest alongside Leah, which is there's already built-in equity, like she said. So from day one, there's money. We'll be creating built-in equity by acquiring discounted properties in the path of progress, renovating to high standards, and leasing to professionals. So if we had to liquidate immediately, there's equity. It works, but we're obviously not going to. Along with that is the cash flow. Investors will receive cash flow distributions from rental income quarterly once it's stabilized. And profits at the end, given the extraordinary growth in the area, we believe these investments will grow a lot in value. I mean, you know, these are prices less than what I was paying, what, 17 years ago when we were buying. It's amazing that you can still get these kind of prices in that kind of a growth area. It's amazing. So, you know, we absolutely believe that values will rise over the next 3 to 7 years. No guarantees, but we think that will be the case. And that profit split will be shared between the investor and us as the managers. So the manager will consider the following property types: new homes. You want to explain, you know, why new homes, and are we getting discounts on those?
So what I typically do when I look at a new construction for a property like this, it's a builder that can't finish, or it's a builder that couldn't finish certain things, or maybe they did something wrong in their build, and so they can't really get a regular buyer to come in. I bought one where they put a metal roof on, and the metal roof had a bow and the builder didn't have the money to finish it. I've come in where they didn't have money to finish windows. Like, all sorts of weird situations can happen with some of these mom and pops that they watch a couple episodes of a TV show and think they can go build a house, but those present unique and great opportunities to get in. And so, like, even this fourplex that I bought today that I'm signing on, builder built it, had a guy on the hook to buy it. The guy flaked at the last minute, and he's in these ridiculous high money rates right now for hard money, and he's got to liquidate it today. So I made him an offer that's fantastic, and so that's where we are. So you just never know what situation you're going to run into. It still has to fit the model, right? It still has to have that built-in equity piece, and so how we get there just depends on what that situation is.
Previously renovated, same thing. Someone may have not been able to finish their flip. Properties needing renovation, so just old homes in the area that they don't know what's going on. It's always amazing, but there's still people who don't know what's going on in the area, right? And are just willing to sell. They don't know that there's change. Predominantly single family homes or small multifamily buildings. That's like less than 4 units.
Yeah, I think the most that we would look at is 8 units, but typically when we get into those situations, it's a few buildings in a small cluster. So it might be one complex with 8 units, but it's 4 duplexes or 2 fourplexes, something like that.
Okay. And here's the highlights. It's diversified. So who is this for? It's really for people who are busy. They just want to invest their money and not do anything else. Like, you don't want to even fill out an application for a loan. You just, here's the money. I want all the benefits of real estate, but I want you to do all the work. So that's what this is. Now, obviously at Real Wealth, we have been helping people build a portfolio that's fairly passive, but it's still not totally passive, right? You still have to get your loan, and you still have to talk to your property manager and be involved, and you got to make sure they're insured, right? And if there's repairs, you got to decide whether to do them or not. And you know, there's still some activity, but in a fund, you literally, you know, fill out the paperwork, send the money in, and the rest is done for you. And then you collect your cash flow every quarter. So it's diversified. And so let's say you put 100,000 in, or a couple 100,000, that money is now on dozens of homes. It's not just in, you know, a few. So it gives you that kind of diversification that's really nice. Current cash flow and long-term appreciation, high growth markets, of course, streamlined vertical integration of company operations. You want to speak to that?
Sure. So my primary company is OmniKey Realty. For those of you who know me, I'm sure heard me talk about it. And everything's under one roof. Our maintenance team, our leasing team, evictions and collections team, everything is in one roof for property management, and same vertical type of operation for 17 years. So we've got it down pat. And that is all something that is basically just being taken care of with this in the most easy way possible. So we're not having all those staffing costs and having to hire employees and all those things for this project, or having to take on other partners. So it really leaves a lot of meat on the bone for all of us as investors. And I say all of us because Kathy and I are investing in this fund as well. So everything is very streamlined and just falls right under the model that we've always been doing.
Yep. All right, and why rental housing? I mean, I think everybody knows why, but obviously potential for appreciation. I love cash flow areas that also have growth. I don't want to just be in an all cash flow place. And so that's why this is exciting to me. Potential, of course, cash flow, passive income, more stability and control versus other asset classes. We talked about that. Crypto, I just still can't believe that you can have an exchange company and just be like, all they're supposed to do is be exchanging, and they were spending people's money and no, anyway, that no control over your money and things like that. And I'm talking about crypto. I'm sure you've heard the headline story. So this is, your money is in a hard asset that people need and use, and it's full, open book. You can go see it, you can visit it, you can make sure the neighborhood's nice if you want to. You can go through the books. Like it'll be all open to you. It's a hedge against inflation, of course. This is one of the most important things to remember, is that inflation's not going away. They're never going to get control of it because they never have. All you have to do is look up anything at all that you use and look it up over the past 30, 40 years, and it has inflated in value. Just, I remember 30 years ago, $8 fancy meal was really expensive, so everything goes up, including housing. So real estate is a wonderful hedge against it. Ability to leverage to purchase. Leah just got a loan under 6% in this market. So she has amazing banking relationships, and she's bringing those relationships to us. She's going to do all the work. She's going to get the loan. And if you haven't gotten a loan lately, or if you have gotten one, you know how hard that is, and you don't have to do it. She's going to do it if it makes sense, if we get the right, the right interest rate, which I think she will. And then it's insured, it's obviously insured. You don't have to worry about that. And then the tax benefits are passed throughout. So anything you want to add to that?
The one thing I will mention is, so I did just do what's called a guidance line, and locked that at 5.75 and just closed that. So we have amazing relationships with banks. We do old school business, mom and pop, shake hands. We work with direct banks. We do that not only on this side, but also on our traditional investing side. And so I think those relationships are key. We only deal with local banks. We don't deal with any types of large corporations, anything like that, because it's just very different. And I definitely, we have to keep it open, but I do think we're going to be refinancing and going to buy more assets. I really don't see a path where that wouldn't happen, but of course it can't be guaranteed. But we're already seeing rates come back down, and I locked that when it was at all-time highs. So, relationships are really important in this business, not only from an industry income perspective, also from an inventory perspective. And so, of course, Kathy and I both are bringing those relationships into this.
So here, again, this is a blind fund, so no properties have been identified or purchased yet, but this is the before and after.
So these are properties that I've purchased. So I went ahead and showed one before and after of one that I renovated. So this is what it looked like before. That's what it looks like now. This one just completed, I think, 2 weeks ago. It's gorgeous. And yes, we experiment with these paint colors because in these cities, these are like an old Mayberry. They're super cute, southern towns. They're big money, big investment, but they have character. And so we want to make sure our homes have character, because that's what makes people want to rent them, and they don't all look exactly the same. And that works very well for us from an investment rental perspective. You buy one home in the middle of a neighborhood where every home looks alike, we actually get less rent for that than we do for ones like this that look unique. And that's because people, it's character. They fall in love with that. That's their home. They're not one in a string of a ton of them. It also helps us on property taxes, which we don't really talk a whole lot about, but it makes a huge difference because these homes, they have no idea where to assess them. I actually just got a stack of one of my county's first batch of property tax bills, and I'll tell you, so like these are homes in Greenville. Here's one that's assessed for $136,000. Now again, this is an infill property. It's worth about $190,000. Here's one for $91,000 in Greenville. So again, these are renovated, gorgeous homes. They don't know where to assess them because it's a mishmash of homes in these infill neighborhoods. And so often our return can double because of that property tax benefit. And so we, there's no guarantee for it, but I can tell you of my entire portfolio, I have almost nothing assessed at full value. And that makes a huge difference on cash flow. And these infill properties, it takes them years to even figure out that the value has gone so high. I've got properties in Collin County, they're still sending me bills at $150,000 assessment. It's crazy.
Wow. Beautiful interiors.
Yeah, so we do shaker cabinets and all the ones we replace cabinetry on. We always do vinyl wood floors throughout the entire unit, no carpet, new vinyl windows, granite or quartz countertops, pretty similar. We'll change up paint colors. Sometimes we'll do gray cabinets. We don't play too much with the trends, but we do play just a little bit, again, to give that individuality to each property.
Another one before.
This is another one just finished. Yeah, super cute. So you can see we even change layouts where we can. We won't spend a lot of money moving layouts because that's not worth it. But a lot of these older homes, some of them have 2 entrances. Some have a second bedroom that walks into a 3rd bedroom. Any way we can cheaply modify that, we do. So this is one I just bought. Actually, Michael found this one. $74,000. You read that right, $74,000. Rehab's $25,000 for a full gut job. All in is $99,000. Rent rate is $12.50. You see numbers like that since 2012? Because I haven't.
It's incredible.
Yeah. Oh, and by the way, that home is worth about $170,000, just for anyone wondering.
Wow.
Here's another one I just signed on. $85,000 purchase price, $42,650 rehab, all in $127,000, worth about $185,000. Rent rate $1,400. And these are this month.
So yeah, typical investment will have 5% cash on cash or more, 2+ bedrooms, 750 square feet, $1,200 average monthly rent, and values from $155,000 to $280,000 after repair value. And in the first year of operations, we intend to purchase all investment assets on cash basis. Once the investment portfolio is stabilized, about 12 to 18 months, we may evaluate the environment then. Who knows? At this point, it's really hard to predict anything, but interest rates and other market conditions, and may determine that it would be beneficial to secure financing, which we think it will be.
And the one thing I will say is we will not be doing one loan for all the properties. We will either do individual or bulk a few at a time, because that's the most advantageous way to do it.
Great. So again, the way it works is you go to growdevelopments.com, you read the PPM, you can download it. I'll do a separate kind of video on how that all works, but it's pretty intuitive. When you get there, you have to put in if you've already filled out everything for Real Wealth, you have to do it again at Grow Developments. Put your name, address, all that stuff. Then you'll have access to the documents, and yes, it'll be on the. When you go to Grow, it's changed a little bit. Growdevelopments.com, you scroll down a little bit and you'll see the Texas Fund. You click on that, that'll take you to the investor portal, and that's where you'll get everything. And you do still have to put your name and information in there. Once you've read the documents and you like what you see, you would need to prove your accredited investor status. You can either do that through a professional like a CPA, or an attorney can verify you, or you can go to verifyinvestor.com and put the paperwork in to prove those things. And then you get that over to our team. Once you've been approved, then they give you the wire instructions, $50,000 minimum, although we are able to take an occasional half unit, so that you can still invest with 25 units if you want to just test it out. Maximum amount is 20 million, and the minimum raise is 2 million. Deadline 120 days from published date with a 60-day extension. Offering close date 9 months with a 3-month extension. Again, this is accredited investors only. And distributions, the first amount equal to 100% of capital returned to the investors, then 75% of company profits to investor members, pro rata, and 25% of remaining company profits to the manager. So you're really just investing alongside Leah. She's doing all the work though. Thank you, Leah, and her team. And for that, the manager gets the 25% of the remaining company profits after you've received your capital. All distributions are made at the manager's sole discretion after expenses, fees, and allowing for any reasonable reserves. Investor distributions are paid pro rata, as said. The manager expects to provide quarterly distributions starting 2 calendar quarters after funds are deployed by purchasing real estate assets. You can tell this was written by our attorney. In order to give preference to early investors, each investor member will start sharing in profits after it has been a member for 2 calendar quarters. Fees, the manager will be reimbursed for all expenses, of course, annual asset management fee of 1.5% of total asset value under management. Normally, I've seen 2%, so it's a good amount. Calculated and paid on a quarterly basis. Acquisition fee of 4% of the total of the purchase price of each asset invested. That's to pay for the work of renovation. So instead of having to pay retail, we're getting these properties at a discount, and that acquisition fee goes to all the work that is going to go into that. And so invested in purchase by the company and the repair renovation costs invested. The disposition fee of 1.5% on the sale price of each asset. And if financing is obtained after stabilization, there's a 1% fee on the principal amount of the loan. The guarantor on the refinancing of the portfolio may receive a fee up to 2% of the principal loan amount for providing the guarantee. Marketing website platform fee of $25,000 and $250 per subscriber. This comes out of the fund. And the manager will also receive 25% of the profits of the company. Okay, so the estimated timeline. This timeline, again, is an estimate. The manager has the sole discretion to determine when and if a disposition of refinancing of a property will occur. So the capital raise, 3 to 9 months. Portfolio stabilization, 12 to 18 months. And the hold, 3 to 7 years. And it is illiquid. It's not like our lending fund. We have Missy's fund that you can have your money come in and out, but this is not like this. The money is going in to acquire assets, so you can't change your mind and decide you want your money back because it's already been spent on the asset. Okay. Potential risks. Again, it's a blind fund, but it's pretty specific about what kind of investments will be purchased. So it's not that blind, in my opinion, but it's called a blind fund. It's unknown if sufficient properties that fit the parameters will be available, although at this point that's not really a risk because they are. Limited geographic diversity, as all properties will be in North Texas. Again, this is all our attorneys wanting to make sure you know the risks, but we don't really see that as a risk because North Texas is pretty big still, right? It's huge. Again, it's illiquid. It's just important to understand that you won't get your money back till the fund is liquidated in entirety. Changes in market conditions such that homes do not appreciate as anticipated, and that's certainly possible. We don't see it, but things could change. They could decide to pick up all of these huge warehouses that they're building for billions of dollars and move them somewhere else, but probably not. Okay. And then the reporting, business activities such as purchases, sales, and refinancing, we'll report that to you. Key information about assets under management, location, status of development, quarterly unaudited financial statements, information reasonably necessary for the preparation of income, tax returns annually, including Schedule K-1s, other such periodic reporting as provided for in the operating agreement. So again, the next steps you all probably know if you've done any syndications in the past. Ann Triplett and Kathy McBride have been with us for a long time. They are the people, the counselors that you talk to if you need help with any of the process of filling out the subscription agreement or uploading it or getting accredited. Like, they are really on it and are there to help you. Ann has invested in a whole lot of the projects, so she's been through it, helps lots of investors, because these are legal documents and there might be questions that you have. So they are there for you. Syndications@growdevelopments.com. And again, if you go to growdevelopments.com, that's my new website. And if you just scroll down a little bit on the main page, you'll see where you click on the Texas Fund, and that will take you to the investor portal. So we got lots of questions. But before we get to that, I want to let you know I'm going to Dallas in 2 weeks, and Leah will be there. It'll actually be her birthday. So on December 2nd, we are going to hold a meeting. She's got a meeting space from 2 to 5 p.m. to ask your questions and just get to meet her and hopefully some of her team in person. Then we'll have dinner after. It'll be really casual. I was going to be there anyway, so I just said, hey, Leah, let's just have a gathering. So it'll be at the Hyatt Place in Allen. If you want to stay there, that's a great place to stay. That's where the meeting will be. And then for anybody who wants to go on a tour the next day on the 3rd, that will be different kinds of properties, not necessarily ones that will be in the fund, but if you'll be able to see the areas. And It's free. Leah's covering the costs of the meeting space and her time. She likes to educate for free, so thank you, Leah. But if you're going to be in Dallas, just let us know. Just send an email to syndications@growdevelopments.com, and we'll make sure you know about. We're also going to send an email after this, and you can just click on it and get the details for the tour. Again, the Saturday tour is going to be more if you're building your own portfolio. Leah's going to take you to some of the new homes that are available, and maybe some of those will end up in the fund. But the fund focused one is going to be on Friday afternoon, and the tour on Saturday. And any Oklahoma ones on that, or?
We can absolutely go by Oklahoma. I've got 12 single families that we'll be releasing next week, new construction, and I can show those areas, show that massive casino that's driving all these thousands of jobs. So yeah, it's 5 minutes away. I think what we'll do is we'll hit Grayson County, so Sherman, Denison, and we'll head up to the border of Oklahoma. And if we have time, I'll also take you to Bonham. It's just going to depend on how many properties. We've got a lot of new construction available right now, so we'll have quite a bit to see.
Great. Okay. So you can do one or both. Yes, that's Friday the 2nd, and then the 3rd is the tour. Is this, I'm getting to questions now, is this LLC fund structured as a DST so we can 1031 exchange into it? No, it's not, and the DST rules are so strict. It may be that in the future we can do that, but not on this. There's just, you have to know what, you have to already have it stabilized, and so maybe in the future we can do that, not on this one. Let's see, is this being recorded? It is, and we will have it uploaded so you can see it on the Grow Develop, well, actually on the portal, the Grow Developments portal. Is depreciation passed through to investors?
You'll need to talk to your CPA. Sorry, I didn't know if you were fielding that one or me. You'll need to talk to your CPA about what tax benefits you can see from this and how that will structure. And we can't give tax advice. I can tell you generally there are typically tax benefits for one like this.
Yes, and it is a flow-through structure. Mm-hmm. Does Real Wealth manage this fund? No, it's Grow Developments, which is my new company. So it's me and with Leah and Leah's new company that you will see on the documents. If it will take 12 to 18 months until stabilization, does that mean 12 to 18 months until the first distribution?
No. So we'll start buying property immediately. So you might have 2 or 3 purchased, those are rented up while we're still buying, so on and so on, and we'll be refinancing throughout the process. So once we get started acquiring, I don't see any reason that, again, 2 calendar quarters would be when we would do the first distribution.
Great. We did not get a lot of questions today. Normally we have lots and lots of them, but maybe you answered everything. But one said this is not a question, but thank you for the presentation and for sharing your time and insights. Okay, so let's see if there's, oopsie, I did not mean to do that. There we go. So thank you again. Growdevelopments.com, whoa, what was that? Got to get back to the contact page so you see it. Yes, syndications@growdevelopments.com is how you can reach out about the tour, and any other questions, then of course at growdevelopments.com. Thanks everyone. Thank you, Leah. Really appreciate your time and all that you're doing for us.
Thank you so much for having me. Look forward to seeing everyone in a couple weeks.
Likewise. Take care. Bye-bye.